In this video, I'm going to talk about the differences between IUL and whole life insurance. Now, if you're going to come to this video expecting for me to tell you which one is better, you're on the wrong video. I am not going to share with you which one is better. I'm going to allow you to make that decision for yourself. But what I want to do the best that I possibly can is educate you from a 30-foot overview as the differences between the two, because I know you're on the internet right now, scrolling around, finding out which one is better. And people ask that question. Is whole life better? Is IUL better? And you get two different camps. You get one person saying that whole life is the best place to store capital. And then you get people that say whole life is dead. Whole life is the worst place to store capital. And you get people that say IULs is the greatest place in the world to store your money and to grow, and to some people are using it as an investment, so on and so forth. But then they trash the whole life side of things, and they're sharing that whole life is a terrible place. And I'm going to do my best to be as agnostic as possible, to just share with you the differences between the two and allow you as the consumer to make the best educated answer for yourself of which one is better, which one do you want. And a lot of it's around based on what it is that's your goals. So with that being said, let's go ahead and dive into it. All right, so I'm going to go ahead and share my screen with you, as I like to do, to give you the differences between whole life and IUL. And I'm going to share with you my professional opinion on essentially the pros and cons of both, and essentially share with you how they both work and operate. And hopefully from this video, you can best make the best educated decision for yourself. I'm not here to tell you. I think when I tell you which one is better, well, I think now I'm in the convincing business. And I truly believe that all financial products have a certain place in the financial industry because you're the one making the decision for yourself on which one's better. See, they're all going to have a unique utility and they're all going to work a specific way. As long as you understand how they work and you understand how they function and you're okay with that and you're educated with that, and you're like, hey, I know the pros, the cons, the risks to this product, and you still want that, then amazing. That's the right product for you. If you go into it and someone's telling you that IUL is the greatest thing and you should not consider whole life at all, then you probably should run, because they're probably having a inherent benefit from a compensation or a belief. They're putting their own beliefs on you. Or if they say, hey, whole life is the greatest place to store money, IUL is the worst place, you probably should just reconsider a standpoint of, hey, like, why is this person just shoving this product down my throat versus saying like, hey, does this product accomplish the goal that I want? And hopefully, if you get the opportunity to work with us, our entire team operates based off of that function, is that very agnostic on products. Products is not going to get you financial freedom. Your mindset is going to get you financial freedom. How you think, how you operate, your goals, your why, those are the things that are going to build real wealth to you, because no product's going to fix anything. Right? You can't have a product be a magic bullet. If you're watching this right now and you're thinking like, oh, I need this product because this product's going to solve all of my problems, you have came to the wrong place, because I'm here to tell you that that's not how it works. You can get a product set up, and if you don't use the product in the right way, then the whole thing can fold and implode. If you don't have the right mindset to creating generational wealth, if you don't have the right product to building more wealth, if you don't have the discipline to create wealth, well, then none of this is going to matter at the end of the day. But if you do have the right mindset, well, now this is where the product can enhance that mindset and you can really build wealth. And so in this video, I'm just going to share with you two products that can both help you increase wealth, increase your overall efficiency, and hopefully help you reach your full potential. And I'm not going to say one product's better than the other. As long as you understand how they both work, that's what's important to me. So we're going to go ahead and draw a line down the middle, as I always love to. And on this left side, we're going to say whole life. And on this right side, we're going to say IUL. Wow, that is massive. That is a massive ink. All right, that's what we're going to use. All right, so whole life. Excuse me for any words that I spell wrong. I spell insurance wrong all the time. Go follow the And Asset TikTok. Giving myself a quick plug right now. The And Asset channel, a quick plug. I spell insurance on there wrong all the time. At this point, it's autocorrect. It's kind of bad because insurance is what we essentially sell, and insurance is the one thing that I spell wrong all the time. And I've been doing it now for like 8 years, which is perfectly fine, which doesn't matter. It's not how I spell. It's essentially, do we know enough to be able to help you accomplish the goal that you're looking for? All right. So first and foremost, let's talk about whole life. Whole life has guarantees, something like that. All right. Guarantees. You are contractually binded by law to getting guarantees in your whole life insurance policy. They are also going to provide a dividend. Okay. So you being an owner of the company, because you have a policy, if you're working with a mutual carrier, so that's the only caveat, you have to work with a mutual carrier or you're not going to receive that dividend. So make sure if you're going to use whole life insurance as a product, you're with a carrier, an insurance company that is a mutual carrier, so you get a dividend. Now, on the whole life standpoint, the cost of insurance, the insurance cost, is a little bit more expensive earlier on. Okay. This is going to be early. Okay. A lot of the insurance costs are built in from the very beginning. Therefore, when you're younger and comparative to, let's say, an IUL, the costs are going to be a little bit more expensive earlier on. Now, from a whole life standpoint, the fees, essentially all of these things are going to be a little bit lower. Okay. And when I say fees, I mean cost of doing business. When I say the standpoint of how much cash value you have early on is essentially what I'm really trying to get at. The dollars that you have in a whole life policy when designed properly, you will have more cash value in your whole life product than you will in your IUL. The IUL standpoint is going to be a place where you will have more cash value later on versus earlier on. And I could even go ahead and share with you examples in a different video, the differences, and I'll go ahead and tie that together on the actual numbers. But when it comes to the whole life, you should have more than likely, more cash value earlier on because you will have less fees than you would with an IUL standpoint. Now, from the whole life standpoint, it's not attached, does not follow the market. Okay. It's not attached to any S&P. It's not attached to any market. It's completely off the grid, right? It is specifically based off of these two factors that I had here. The guarantees, which is why people love whole life insurance, is because there's guarantees. No matter what happens contractually, you are going to get a guarantee. World falls apart, no dividend, companies aren't profitable, so on and so forth. You are also going to get the guarantee. Now, depending on how profitable the company is, there's going to be a dividend that is going to get paid out. The companies that we use, they have paid dividends for the last 100 plus years. And so we use the companies that have strong financials, that have been around a while, that have paid these dividends, that are mutual carriers. So as long as you're with the right company, you will make sure the whole life is going to be a great product if it's designed properly based off of all of these. So it's not following the market, which from a strategy standpoint is great because if the market goes down and you don't have to worry about volatility, and you get a compounding interest and a dividend that same year, well, now you have more dollars to essentially borrow against and use to be able to go build more wealth. Because what happens a lot of time when the market's down? A lot of other assets are also down, which means things are on discount. And when things are on discount, well, now that's how you build real generational wealth. All right. So let's talk about the IULs. IULs typically have a floor. Okay. And what that means is essentially if the market goes down negative 50%, a lot of times you will have a 0 to 1% floor. So if the market goes negative 50, the worst you could do is essentially get that 0 or to 1% that will be credited to you as a policyholder. Now, there's upside with that. And there's going to essentially be a cap that's involved with it. And a lot of the times you'll see the cap be, let's just say from 8 to 12%. Now, it could be more, it could be less. All caps with different carriers are going to be different. And so I'm just trying to give a general overview of the differences and not be specific with numbers by any means. So let's just say the S&P 500 gets 30%. Well, your cap, let's just say whatever this number is 12%. So then you'll get credited 12%. So if you have 5 years in a row where the S&P did over 12%, well, your policy will have got credited 12%. So now we're going to talk about fees, higher fees up front, higher fees. Okay. There's just a lot more fees that are involved because there's a lot more moving pieces, a lot more levers that are being pulled. This is essentially an option strategy for the insurance company. So another thing to consider is that the policy in itself is not in the market, but it moves with the market. Should have used a smaller thing, but that's okay. So it moves with the market. So essentially whatever the S&P, and it could be in different indexes, right? I always would encourage that if you are going to do an IUL, for complete transparency, a lot of times some of the best, most straightforward indexes are just going to be your S&P index. There's lots of other indexes out there, but I think personally at the industry now, there's hundreds and hundreds and hundreds of different indexes out there, and it's hard to know what's in them. It's hard to know what's going on with them. And so to be complete transparent, that is one opinion that I do have, is that a lot of the time just being as simple as possible and just being strictly in an S&P 500 index is going to be your best bet for you to try to understand the strategy. Now, because I said that this is an option strategy for the insurance company, I truly believe that as a agent, unless somebody knows how options work and they're an expert in options, it's really hard to be an expert in an IUL space. Now, that doesn't mean that you can't understand the IUL from a 30-foot overview or understand how they work from a systematic standpoint, because at the end of the day, you still have some of the same benefits. You still have a death benefit. You still have cash value. You still can borrow against it. It still works the same way of having a 0% floor with upside with certain caps, so on and so forth. But unless they actually know how options really, really work, well, they don't really understand the strategy behind how insurance companies are using it to create the rate of returns that they are, and being able to use this as a strategy from the insurance company standpoint. That is a little bit more complicated, and I think it does take a little bit more expertise in the option space. So when it comes to this, the higher fee standpoint is at the beginning, but the cost of insurance at the beginning is lower, okay? Is in the beginning, okay? Lower cost of insurance, okay? In the beginning, I want to make that very clear. Later on, what ends up happening is the cost of insurance, it's called the COI curve. And I actually learned this from one of my good friends, Brian Schick. Good shout out to our mentor. He shared that the curve essentially goes like this and then essentially shoots straight up when it comes to things like in universal life products. So whole life will start higher. It'll come like this, and then it'll eventually come down. When it comes to index universal life, it'll come up and then gradually. And so like at some point in time, the cost of insurance for the IUL will become higher and more expensive from a death benefit standpoint than the whole life policy. Now, there are some other factors that can inhibit the how expensive the cost of insurance can be if you essentially are funding this properly. You really want to make sure that you're funding an IUL properly, because if you don't, well, then this strategy from an index universal life strategy can get very dangerous, because if you have too many fees, too much cost of insurance, and there's not enough cash value in the policy and you're not funding it properly, well, then you can essentially lose all of your dollars, and you can essentially have the policy lapse just because it wasn't funded properly. Now, as long as it's funded properly and as long as it's designed properly, well, then you really should have nothing to worry about from a policy lapsing standpoint. Now, when it comes to illustration standpoint, this is where whole life insurance and IUL standpoint, I think, can get dangerous, because what too many times happens is in the industry is we start playing this illustration game. And this illustration game is which one's going to do better, which one's going to outperform an IUL to an IUL when it's looking at companies. Is the whole life going to be better? Is the IUL going to be better? And we look too much at the actual illustrations. Because when you look at an illustration, the IUL is essentially going to blow the whole life out of the water. It should be 100% of the time, just looking at the illustrations and numbers, because the numbers are going to probably show closer to 5 per 6 internal rate of return on the IUL versus the whole life being, right around 4% of an internal rate of return. If that happens, well, you should have something that's going to show more cash flow. It's going to show more essentially dollars that you can use for. So when it comes to which one you should or shouldn't use, well, I don't think one is better than the other. It's going to depend on which one you feel more comfortable with. I think with an IUL potentially having a little bit more risk involved, just because there's more levers that are being pulled, not quite understanding exactly how an IUL works for most people, even agents. I think that's where the risk comes into play as well. I think that because of the way the industry is set up, having IULs show these great exuberant numbers, I mean, the numbers are really phenomenal in what these things look like. It's hard to say that, is this going to work out the way that it's supposed to? I think there's a lot of studies that show that because options are getting a little bit more expensive and cap rates are coming down, well, we get shown one thing today, but 10 years from today, the numbers more than likely are not going to perform the way that they're showed. And it's the same thing with the whole life insurance policy too. I think a lot of the times we show numbers because there's dividends and guarantees involved, but because the dividend can change, right, either higher or lower, the numbers may not be exactly what they are. Like, it's odds are they won't be. But I think history has shown that in a whole life policy, the numbers are going to be a little bit more accurate, especially if you design it properly, than in the IUL space, because the IUL space has a lot of moving levers that really are affected, and the effectiveness that is being affected are immediate. And what I mean by that is because it's an option strategy, the option strategy is affected almost immediately based off of buying puts, so on and so forth. When it comes to the whole life policy, because the thing that matters on how they perform and the things that get accredited is the dividend gets changed based off of interest rates. As interest rates go up, well, so does dividend rates go up. As interest rates go down, well, so do dividend rates. And by that happening, it takes longer for the dividend to essentially be affected by the policy, because what's actually going on when it comes to the whole life side is these insurance companies are buying bonds. And when they buy bonds, they're essentially putting their monies into these bonds that have to have a maturity date. And it takes some time for these bonds to hit their maturity date, therefore affecting the overall growth of their portfolio, which then affects the overall dividend of the whole life policy, so on and so forth. And so I think when looking at the two, in a whole life policy, you're going to have more cash value earlier on if it's designed properly. And in IUL, you're supposed to have more cash value later on in life. And so you have to ask yourself, what is my strategy? Am I using this to borrow against for real estate, for business, for opportunities? If I'm doing that, well, then maybe I want to consider having more cash value earlier on, because it gives me the ability to not lose out on the lost opportunity cost of my business, of the real estate, to essentially produce more wealth for myself. Because if I have higher fees up front, like I mentioned here, well, then I have less money to essentially borrow against to go build for my business, to essentially use for opportunities, to use into real estate. Because you have to ask yourself, I'm getting, let's just say 5 to 6% in IUL, but I can go get 30%, 20%, whatever my investment strategy is that I know well. Well, maybe that extra, 10 grand, 20 grand, 5 grand, how much, depending on how much you're putting into it, may be more beneficial for me to have earlier on so I can go build more wealth. But if you're somebody that says, hey, like, I'm looking for something for more of just a retirement tool that I can have more cash flow later on in life, well, maybe an IUL may be better for you. And if you understand how the product works, because, well, if you're going to have more cash value later on and that's more important to you, well, then there's a good chance that you can take more income from that based off of the way that it functions and having a potential higher rate of return. And so it all comes down to the strategy that you want, the strategy that you're looking to use, understanding how they both work. And when you understand how they both work and some of the nuances of the fees, the death benefits, how they operate, some of the costs, what they're based off of. If you're somebody that's completely against the market and you're like, hey, like, I don't even want to deal with anything that's attached to that. Well, it's like, well, then we know that the whole life is going to be you. If you're like, hey, like, I want a little bit more potential upside, and I understand how the IUL works. Well, it's like, hey, like, you understand that the floor is 0 and you have more upside. Well, then maybe an IUL is for you because you're like, hey, like, I want to use this for a retirement tool. I'm not somebody that has a business. I'm not somebody that has real estate. I'm not somebody that has this mindset for investing. And I just want my money to be in a safe place where I can have liquidity if I need to for, emergency, so on and so forth, that I can also use for the future. And maybe I want to use it for kids' college. Like, there's going to be lots of things that come into play on what it is that you want, if you want a whole life in IUL. And that is where we come in as the advisor to ask you great questions and for us to come in and educate you on the differences between the two. And then for you as a consumer to make the decision on what is best. So don't let anybody tell you that one is better than the other. There's lots of people out there that are doing it great on the whole life side. Lots of people that are doing things great on the IUL side. There's lots of people that are doing it really, 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 really bad on the whole life side and really, really, really bad on the IUL side as well. So just make sure based off your goals that it's designed properly. If it's designed properly, based off of the goal of, hey, I want it for cash value, well then, hey, there's a really good chance that you're going to want to making sure that one way or another it's funded properly and it's designed properly. If the death benefit is the goal, well then maybe we can now start looking at a design slightly different of having less cash value, because that's kind of how it works is you have less cash value, more death benefit. You either have more cash value, a little bit less death benefit. And so that's kind of some nuances to look at and for you to kind of consider and pay attention to. So if you have any other questions in regards to, the differences, pros, cons, how ones work over the other, please let me know. and I'm here to help. And if I don't know the answer, I'll definitely make sure to point you in the right direction. Let me know if there's anything else that you'd like to learn, anything else you'd like to get educated on. And until next time.